Good morning and happy Friday morning from the Asia Pacific. Half an hour to the opening bell, Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Chung-Wilkins.
Our top stories this morning. President Trump announcing extra 10% tariffs on Chinese imports starting next week, along with 25% levies on Canada and Mexico.
And on that news, the dollar is on the up this Friday on those tariff plans. Asian stocks tracking losses that we saw on Wall Street after that plunge out of NVIDIA. Hong Kong shares, though, are still on track for a seventh week of gains.
Also ahead, China ramps up its rhetoric against Taiwan, warning the ruling party against any independence moves. We hear from the Taiwanese vice premier on boosting the island's defenses.
And Xiaomi is a stock in focus this hour as it launches this high-end model into an increasingly competitive EV market. Good morning and welcome to the show. The state of markets going into the open today is one that is, as you can see, fairly risk-off, substantially on price, right? So it's rare that you get a 2% handle on both the Kospi and the Nikkei 225. So without even the Hong Kong markets opening up, and maybe we'll see if we get an offset to the positive side in Hong Kong. We're down about 1% on the regional benchmark, which actually sets us up on an Asia-wide basis for the first weekly drop in, I would say, about 7 or 8 weeks. You have to go all the way back to January for that as well. Right. Now, the euro is bid, although on a weekly basis, the dollar, I guess, on the other side of that trade is on track for the first weekly gain in about 3 or 4 weeks. Yields are pushing lower, so there is a tone of, again, risk aversion out there. Not on your screens is gold. Losses, though, but again, we've hit successive record highs as far as the gold prices go. Right. Let's flip the boards and have a look at how we did overnight. Some of the big names we were tracking have been tracking because of the rally taking place there. And it's worth noting that it is, of course, the last trading day of the month. And is it? Yeah, it's probably, yes. Yes, it is. It is a leap year. And, so far this quarter with the full month left, Hang Seng Tech Index is actually on track to outperform. Flip the boards, please. The NASDAQ index by the most on a quarterly basis performance spread going back to at least 2015. So at least it's a 10-year, it's been at least 10 years since we've seen this outperformance so far. We're called lower on futures. We have a 1.8% handle now. Wow, check that out, right? On the 10-year yield. But this is the one that really very much in focus, Rebecca, of course, following the news out of Donald Trump. March 4th, a day to watch, certainly.
Yeah, absolutely. We have had the sort of fresh injection and this fresh jolt of risk when it comes to tariff risks. And we're seeing that reflected, actually, when we think about the UN. So just eyeing and keep an eye on the UN fix that comes through today. For the USD offshore yuan cross, we did see that just hitting that 50-day moving average. The onshore yuan just a touch below the 50-day. And to your point, Dave, of course, we have a 7th week of gains in Hong Kong if we close at the current level. So just for example, HSI is up about 1% so far this week. A couple of new releases by Xiaomi, Tencent. These are two names, of course, that have been top of the list for southbound investors that I think, if we continue, are on track to reach the second largest inflows southbound that we've seen so far. A new car release by Xiaomi, so there we go. A new Tencent AI platform that's said to rival DeepSeek in terms of speed. And then keeping an eye on bubble tea stocks. We've had this optimism, this huge demand, actually, for Mixue IPO that's coming through on Monday, that sort of spill over into other bubble tea names. Couple of earnings to watch. And then Macau GDP, that's coming through today. Last month, 4.7%. Just keep an eye on that. Dave.
Yeah, okay. So it's going to be very busy, and we haven't even mentioned that it is the NPC, of course, next week. So traders are looking ahead to that. Any sort of surprises? We've had, in fact, a preview out already. So apart from the growth number, is there an inflation number that actually might tell us or might be indicative of what the stimulus stance is out of Chinese officials? Now, a lot of those moving parts will really have to do with what happens across the Pacific with Donald Trump. And overnight, we have, well, at least the positive news is we have more clarity. The bad news is we know what they probably will be next week, with President Trump saying that 25% tariffs on, this is on Canada and Mexico, are on track to go into place early next week. He also said on the Chinese front, they will face an additional incremental. So this is on top of the 10%, additional 10% on exports to the U.S. And a move certainly that could worsen, if not already, trade relations between, of course, those economic blocs. Let's bring in Min Min Lo, our China correspondent, here to talk us through the latest here on. Let's start things off on the China front.
Yes, so this is a 10% tariffs on top of the pre-existing 10% that kicked off on February 4th. So the second round will kick off a month later on March 4th. And the pretext of this, once again, is the fentanyl issue. President Trump is saying he will impose those levies on Mexico and Canada on March 4th as well, after that 1 month grace period, despite Mexico and Canada taking those actions to strengthen border security. And so it does beg the question of whether Trump is actually sincere in negotiating on good faith here, because even after these concessions from the neighboring countries, the tariff rates remain unchanged, and he's slapping on this additional tariff on China as well, saying that drugs are still entering the U.S. and that the precursor chemicals are coming from China. And Bloomberg Economics had crunched the numbers. They said that the original 10% tariffs might still be manageable for China, but the additional 10%, that would be equivalent to about double the scale of the first trade war. It could cut China's exports to the U.S. by about 50%. And of course, the most immediate reaction we have seen in markets is a slide in the yuan, and also overnight the Golden Dragon closing down close to 1% lower.
I mean, earlier this week, we basically saw President Xi going out and telling officials just to keep calm and carry on. That came after some of those announcements on CFIUS, the proposed restrictions on curbs, on semiconductors, more shipping restrictions. But before, of course, this latest 10% additional tariff. How is Beijing responding now? Do we see any shift in their positioning or their stance?
Well, so the Chinese Commerce Minister Wang Wentao had written a letter to the U.S. Trade Representative opposing the 10% tariffs, but it wasn't clear in the letter whether he was referring to the first round of the 10% tariffs or the second round of the 10% tariffs. But I'm reading it as the first round of tariffs, because the letter also said that China has taken countermeasures. We know that China has retaliated with levies on U.S. oil, LNG, agricultural machinery. But as far as I understand, they haven't yet released the countermeasures to the second round of the 10% tariffs, which will kick in on March 4th, U.S. time, which will be about March 4th, 1 p.m. Beijing time, which, by the way, is the first day of the CPPCC session, the first of the two sessions that kick off next week. And that's when we will likely see China retaliate. If they follow the playbook in February, they retaliated exactly at around 1 p.m. So that's when we could hear what countermeasures China might take. And of course, we're still waiting for that call between President Xi and Trump that was supposed to happen, quote, as soon as possible, but still hasn't happened yet. Yeah.
Okay. Min Min, thank you so much. Min Min Lo setting up the trading session for us this Friday. Certainly a tone of very much risk aversion out there going into the thick of the Friday session here. Right, let's get more context on these markets with Paul Dobson in Singapore for us. He's our executive editor, of course, for markets across the Asia Pacific. Paul, good morning. And we woke up this morning to a struggling U.S. market, massive losses in Europe. NVIDIA, of course, was very much in focus as well. Very much risk off today. What's your team watching?
Yeah, morning, David. So, as you said, the U.S. equity market came under a good deal of pressure, not just because of the tariffs, not just because of the tech sell-off, but also because of what we saw in the U.S. data, which was, yes, growth still looks strong, but also inflation remains sticky. And we heard from a catalogue of Fed speakers that they're still worried about inflation and want to keep interest rates restrictive. So that did a couple of things. While it sank equities, it kept bonds relatively in check and lifted the dollar quite a lot. So all of those things fed through to that stronger dollar. I'm sure you would have spotted it, David. The offshore yuan having its worst day, I beg your pardon, since December. And so for Asian currencies that haven't yet had an opportunity to respond to that, they're going to be coming under pressure today. We're going to be watching the likes of the Indonesian rupiah, in particular Southeast Asia currencies as well, Philippine peso, and over into the Indian rupee as well. Those sort of tariff-sensitive currencies, also sensitive to interest rate differentials as well. So I think that's going to be one area where traders will be quick to express their concerns here. What we see in terms of the response in equities, I think, could be a little bit more nuanced. People still hanging on to that China outperformance and growth story in some sectors, at least for the EVs, for the technology. Still some more supportive news coming through on that sort of side overnight. So it could be FX is the place to watch for the most clear and obvious response to the overnight developments.
Paul, I mean, I think it's probably fair to say that up until last week, the prevailing narrative in markets has been that Trump's tariffs are manageable. They've been fairly restrained when it comes to China and indeed, of course, various US allies. We've seen a pretty significant step up over the last few days, culminating really in this additional 10%. We're now, of course, at 20 percentage points when it comes to China. Do you think that the narrative when it comes to Trump on China is now starting to shift in markets? And how are we seeing that expressed, thinking also particularly in Chinese markets, if at all?
Yes, Rebecca. Well, I would say it's much more of a global thing than just China. But, you know, I think you're absolutely right. Up until last week, that had been the prevailing view. But something seemed to change. There was a little bit of a prise en conscience over the weekend, last weekend, where everybody came back to work on Monday when it's a little bit more. Actually, we're worried about what this is going to do to the US economy and to the global economy, and we don't like the look of it all that much. And this week, you've really seen that with bonds outperforming equities quite a long way. It's been that kind of fearing for growth and needing some sort of protection as a result. I think on the China side, you know, we've seen some pretty crazy wobbles and dynamics over the course of this week in the equities market. Some really strong days in Hong Kong as well, on DeepSeek news, on tech news, on all of those supportive factors, on the idea that, yeah, the tariffs are more of a glancing blow, and hope that we'll get something from the MPC in the coming week. Now, 10% extra tariffs ratcheting up quite unexpectedly, without a great deal of explanation, does make you feel a little bit more cautious, right? And I think that the commentary that we're seeing this morning is very much along those sort of lines that, hang on a second, this wasn't really what we were expecting or in the cards. Maybe it's going to make people think twice and take on a little bit more caution on Chinese equities. Perhaps, you know, that rally is going to hold off in check a little bit more. Now, on the other hand, the Golden Dragon Index did fall overnight, but it wasn't exactly a chaotic or disastrous session. So there's still reasons to hold out hope. And I think people will probably be hunkering down and waiting until what we see from the policymakers next week before making any extreme judgments on that tariff situation.
There is certainly a lot of event risk between now and, let's call it this time next week. Paul Dobson there in Singapore Forex, executive editor for Asian markets. And really, just given just the many moving parts out there, certainly one part of this broader Chinese market that's remained steady, and if you think about it, really an anchor has literally been the anchor for the currency, right? The midpoint has been virtually unchanged over the last 10 sessions or so. So 10-day vol on this one, Rebecca, has been almost nearest the lowest that we've ever seen this.
So there's two ways of thinking about that. One is as an anchor. The second is the sort of Lombard ODA view, which is that the PBOC is basically being held hostage to Trump's tariffs.
That's true.
It can no longer move, and its number one priority is creating this sort of stability when it comes to the yuan.
Yeah, and that's why I think short-end rates have been high. They have managed to move to the downside on that.
Yeah, absolutely. Anyway, we'll be talking more about rates. We have an excellent guest joining us later, still ahead. Kai Fang, investment manager and management, will be telling us why they think the Fed is going to be more aggressive with rate cuts, particularly in 2026. Stay with us. That's next. Counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. 15 minutes off. Good morning and happy Friday.
Right, welcome back. Okay, so we thought today was going to be quiet here. We're starting this
Did we,
Dave? Here we go. Well, this is a reminder, I guess, that keep your expectations low. Breaking news, Bloomberg Scoop. This crackdown, it seems, from Japanese financial regulators, this plan in a sweeping crackdown on, get this, nearly 70 billion of high-yield loans backed by JGBs and other assets, which, by the way, have really become a very popular trade of late. So just more details, but you can read more about this, of course, on your Bloomberg Terminal. The Financial Services Agency will be scrutinizing the banks that have increased their purchases of JGBs and then repackaged them into loans and then sold them off over the past year or so. Check that out, JGB yield curve on your screens. From one yield curve to another, let's have a look at where we are on the Fed futures curve as we look ahead to, PCs coming out today. Will it be consequential as far as what the Fed does over the next few meetings? Possibly, possibly not. There's a tariff story that might be adding to inflation expectations, but also the uncertainty. And what does the U.S. economy outlook look like really going into next year? Cao Bin, CEO of Kaifeng Investment Management Hong Kong, is here with us in our studio to talk us through this. And first, good morning and welcome to the show. I think just to give a bit of a background for our viewers. I mean, you guys did very well last year on your fund, macro fund, and your big call right now that not a lot of, I'm simply looking at pricing, not a lot of people think is priced right now is the Fed's going to cut interest rates next year aggressively. What is the market not seeing?
Yeah, I mean, I think the Fed definitely is a big call. And our high conviction is that the Fed will most likely to cut interest rates aggressively next year. But for this year, we are quite uncertain in the sense that there are two things. We actually coined a term called poker rule, combining Powell with Volcker. Okay. In the sense that Powell,
I like that,
by education, by training, is a lawyer. A lawyer pays much more attention to evidence. The current evidence is inflation actually elevated. So he's unwilling to cut interest rate at a stage. And moreover, there's a tariff hanging there. It can be inflationary as well.
Yeah.
Right? And also has a protection, has to protect his reputation in the worker sense. He has done a great job in terms of saving the economy during the pandemic and also driving the inflation down by raising interest rate. And his term ends next year. So I think he will try to hold the rate steady for this year. But coming to next year, the Trump tariffs may do damage to the U.S. economy. And so there's a higher chance for the Fed to cut interest rate next year. And also, when Powell leaves at the stage, it looks like he's going to leave, and Trump appoints someone else, and Trump will very much likely appoint a very dovish governor, and that increases chance of rate cutting next year. So we thought, actually, a month ago, that the market was mispricing this opportunity where all the cuts were priced in this year, 2 cuts, and then from the end of this year to next year, there's nothing. About a month ago. Now it's pricing about half, 12, 15 basis points, and we still think it's not enough.
Not enough.
So if we see, I mean, potentially we're going to see now 20 percentage points of tariffs imposed on China, if indeed that extra 10% does come through. There's still a question mark over that. Does that change your conviction call? Does that change your call at all?
No. Actually, we think that makes our trade even better. In the sense that if you increase the 20% tariff on China, and then the inflation this year will be even higher. Right, that all the tariffs will be imposed and immediately almost, right? So like March or something, right? And so that to decrease the chance of Powell cutting interest rate this year, and the market is still pricing about 2 cuts, a little bit over 2 cuts this year. So the front end rate will go higher. We are shorting there, right? We are paying the front end rate, the 1-year rate, and we are receiving 2-year rate, right? So if the tariffs get hit this year, and the next governor can argue that the tariffs is one time. It's transitory. Fed had made that argument before many times, right? If Trump appoints someone who's dovish, he said because all the tariff will be bad for the economy, and this one-time tariff hike is just a one-time price increase that's not inflationary, so they can cut, right? So that's how we think about it.
Okay.
Can I ask you why, in particular, the 1 and the 2-year, for example? And do you have a target for that? You know, at what point do you know the trade has worked and it's time to exit that?
The trade is working in our favor right now, and moved about 15 basis points. And we think target is that it's if you look at end of 24 to end of 25, the market is pricing as much as 100 basis points, right? So the economy really weakens a little bit. Right now, the economy is good, right, in the U.S. The economy weakens a little bit. We think it can price in anywhere between 50 basis points to 100 basis points. If stock market is really going down like it's Friday, and then this can price in even more, can price in like the 150 basis points. So, I mean, it's still a long way to go from here.
Okay. You've been long on Chinese equities since last year, I believe.
Yeah, that's right.
How is the DeepSeek rally and your expectations on where we go? How is that? How are you positioning around that?
We are generally long Chinese tech right now. And we have been long for the last 1 year. Our position just up and down. But our conviction level increased since August last year.
Okay.
In the sense that we think China is more a perception problem. Many people argue that they want to see a big stimulus package out of China. And I disagree with that argument in the sense that China's current situation is much better than a lot of people perceived. So what's need to change is that a little bit stimulus like last September, and then a lot of change in perception. Then the August Olympics changed some of that perception. And interestingly, you have the TikTok refugee fled into Xiaohongshu or Little Red Note, and that changed the perception again. Then all of a sudden you have DeepSeek. It's a huge change in the perception of China's capability. Right? And that perception change can continue to push the China equity higher, and that's how we think about the market. But we do know that China's economy overall is not very strong, especially the property sector. So we think the policy change is more focused on the consumption side, and at least on the margin, it's switching to that side, right? So it's beneficial to equity, but actually negative for commodity. They are not going to the old road, the infrastructure, property spending, and so we are.
So it's not the 2009 playbook. So I guess my question for you, as a rate strategist, of course, right?
Yeah.
You can doubt everything else in the market,
right?
But you should trust the bond curve. So what is the bond curve in China telling you that the market doesn't seem to see? Is that a cyclical slowdown that the CGB curve's absolute nominal yield is telling you, or is that structural?
I think it's structural. It's not long-term thematic China risk going down. I think the thing we disagree the most is the China next Japan theme. And many people think, oh, China's next Japan, China's like Japan 1990s. We totally disagree with that. We think China is a mix of China, Japan 1990s and Japan 1970s. Okay? Because if you look at the Japanese car entered the global market of the 1970s, right? And then if you look at Japan's economy, it slowed down from 8% to 4% after 1974 crisis, but the stock market from 1974 to 1985. Remember, that's before the Japanese stock market bubble, right? From 1974 to 1985, Nikkei went up, rose 250%. Well, Dow Jones only rose 110%. Right? So we think China is somewhat like that. It's basically in the middle. I mean, the demographics definitely it's kind of like Japan in the 1990s, but in terms of the manufacturing strength, China just entered the world market and shown in the high end that China can do all the high end manufacturing like any other advanced economies in the past.
Right. Just a final thought, very, very quickly, if you can. How do I express that in the equity market? If industrial policy is the biggest game changer, and yes, Rebecca, go ahead.
No, that's exactly what I was going to ask.
Right. I think that China will have see a lot of consolidation.
Okay.
Right? And so the good thing and bad thing at the same time. With a lot of consolidation, and you will see job market weaken, actually. But after the companies are consolidated, and then those consolidated companies can actually have profit almost guaranteed. If you look at the aluminum sector versus the steel sector last year, very interesting. It's all traditional, right? But the aluminum companies did well because they are really consolidated. Well, steel companies did poorly because they are still very fragmented, right? So if we want to look at stock market, I want to look at those industries where it's really consolidated already.
Fantastic. Yeah. Nice to speak with you. I mean, there's a lot more. Let's do this again next time.
Thank you very much.
Galvin there, CEO at Kaifang Investment Management here in Hong Kong. Really sets us up really into what to expect from the NPC coming through next week. Right, well, we have a full trading session left here, and we are called lower 0.4% on the Hang Seng Index. There's some weakness coming through this Friday. We'll talk about many parts of this equity market next. We have some earnings coming through. We have some announcements coming through out of Xiaomi and Tencent. Yeah, so plenty more ahead. Good morning. You're watching The China Show.
Good morning and happy Friday. Welcome back. You are watching The China Show and we're counting down to the open of markets, 30 seconds or so off. And markets really grappling with a lot here. On the one hand, we have the 10% additional tariffs that Trump is said to be imposing on China. On the other, of course, we still have this narrative about optimism over the tech rally. We are set to still be in track for a 7th week of gains in Hong Kong at least. Dave, what are we expecting?
Yeah. I think if things stay the way they are on the index itself, I just got a glance at 2036.616 would still, I think, put us just over the line.
Yeah.
And just to recap, of course, the week, right? What's tended to happen is the morning session has been very different from the afternoon. So let's see if this weakness coming through early on might be indicative of what the afternoon looks like. And certainly we're looking at Stock Connect flows as a function in it as well. Okay, 0.5% to the downside, CSI 300s. Of course, the big news overnight, in case you missed that, and the reason why you're looking at about a 1% drop, if not more, on the regional benchmark is, Donald Trump says tariffs are a go from March 4th on Mexico, Canada, and another 10% on China. Right. That's the macro story for now. Let's flip the page, and the story across Hong Kong markets, of course, has really been one of, we're wrapping up a really fantastic month. Year to date, we're up 31%, I believe, on the Hang Seng Tech Index. 18 billion of inflows across the Stock Connect, US dollars, by the way, this month, which is the second highest total so far on record. Tencent was out with an announcement on its model, AI model. It announced one, said it's faster than DeepSeek. That's number one. And Xiaomi, of course, that new high-end SUV, more than 10,000 orders in the first 2 hours. So, yeah. So earlier on, we were reading a headline, Rebecca and I, and there was Xiaomi's releasing an order. I still have to get my head around that it is a car maker now. At first, I thought it was a handset that it was coming out with as well. Or did it release a handset? Anyway. I'm just getting confused. Right. Speaking of some analyst actions here, Li Auto raised to overweight JP Morgan and to sports, and Li Ning raised to buy both at Citi. CICC 8 shares raised to overweight at Morgan Stanley. A couple of big movers to tell you about. Net income at Jinko Solar down 99%. Shares are coming up shortly. And we're getting some earnings, of course, coming through out of New World. Earnings from Sun Hung Kai came out yesterday, down about 3%, despite, of course, what was a relatively decent set of earnings there. And very, very quickly, bubble tea stocks or milk tea, fruit tea in general did very well yesterday. So this is some of the, actually at the very, if you want to look at the value chain, the stores themselves and some of their suppliers are still seeing some upside. This is crazy.
Yeah, pretty extraordinary. And it's really off the back of this Mixue IPO that we're expecting to come through on Monday. And orders, let me see if I can find it. The margin loan on that was pretty extraordinary, thousands of times larger in terms of that sort of Hong Kong individual investor interest on Mixue. So a lot of spillover, to your point there, for those bubble tea
Less sugar, please,
stocks.
on
this. Yeah. And really, next week, well, shifting gears a little bit, zooming out, it's a big one for China watchers. In fact, probably the big one, if you're a geopolitical analyst at least. We're getting PMI data on Saturday. And of course, then it is the National People's Congress starting on Wednesday. That's also when Trump's extra 10% tariffs against China are said to be kicking in. So, yeah, an enormous amount for us to digest, Dave, for next week. We're joined now by Bloomberg Intelligence senior equity strategist Marvin Chen. We also have Bloomberg economist Eric Zhu joining our discussion. Marvin, I mean, let's start with you. The MPC is always a big one. We're always slightly underwhelmed in terms of the details, typically. But just lay out, what are the sectors that we really should be watching?
Yeah, I mean, typically, the MPC has had a positive impact on the China market over the 1 month after the meeting, making April historically the best month for Chinese stocks over the past 20 years. In terms of sectors, real estate, materials, and industrials tend to outperform during this period just because, how much of the fiscal and local government spending is spent on infrastructure projects. So we think, the MPC meeting can shift some of the attention away from tech to some of these other sectors and kind of broaden out this momentum that we've seen year to date.
Because things have been so good, are expectations high now for next week? Investor sentiment has certainly returned a few weeks earlier than expected.
Yeah, I think what investors want to see is a policy continuation, a continuation of the support measures that we saw in September last year. And this continuation in policy support is not something that we've always seen from China. But in terms of the sentiment, yes, animal spirits have returned to the markets, and it's driven by this DeepSeek, and it really represents that. Despite all the headwinds China has faced over the past several years, China can still remain competitive. And this is something that we've seen not just in the market, we're seeing in the corporate sector as well. Tech sectors is increasing capex spending. Real estate developers are buying land at premiums again. So this kind of sentiment improvement is something that is broadening out.
I guess to your point, Marvin, about that policy continuation question, it's sort of somewhat uncertain given now we also have this additional 10% tariff. So I want to turn to you, Eric. If we do see 20 percentage points of tariffs coming in imposed by the US, do you think that changes what we're expecting to see from the MPC, or does it change expectations going in?
I think it's probably too late. I don't think the government is likely to make a last-minute change to the package they're going to announce. But it could marginally, they might fine-tune some tones in how quickly we are going to deliver so stimulus they are going to announce. But I think in terms of broad continuity, I think the market consensus is now the growth target will be set again at 5%, so about 5%, so same as last year. But I think we believe there will be a notable change in inflation target, which used to be 3% for many years. But that used to be a ceiling, right, saying the inflation cannot go beyond 3%. But we think from this year, from provincial target, it looks like the inflation target will be lower to 2%. So that would be a strong signal. It doesn't mean that the government is saying we must reach 2%, but it's going to signal that they're recognizing the low inflation or deflation is a risk, is a real risk now. So they want to, pump up the stimulus, trying to, stimulate more of the demand, trying to get rid of the deflation risk.
Okay. Could you flesh out that idea more? Because I was thinking about that this morning, looking at previous targets of the NPC, right? So to your point, traditionally, it was a 3% target on inflation. Certainly, the reality is, if you say 3%, it doesn't seem realistic given the reality.
Yeah.
Why would 2% be seen as more pro-stimulus in this sense than what would have been a higher number?
I think it could be signal a change of mindset. So in the past, they worry about high inflation, so they put a ceiling on 3%.
Right.
But now they recognize that, okay, the problem is not low inflation. Okay, we no longer need to worry about 3%. Actually, we want to get probably 1% or even 2%. That would be a good sign for the economy. So I think that's a very significant change in the government's policy mindset, right? So we want to pump up the price instead of containing the price pressure.
Team, fantastic. Thank you so much. That's the preview, and we're all going to be busy next week. Eric Zhu there, our economist, and also Marvin Chen, our senior equity strategist out at Bloomberg Intelligence. As we were having that conversation, markets have continued to come under more pressure incrementally. So with the Hong Kong Open now, we're now down over 1% on the regional benchmark. The Nikkei's off about 3%. You have the Kospi index now down about 2.5%, and the dollar obviously has been catching a strong bid on the back of news coming through. And again, a lot of it is about positioning, and certainly with the new news overnight, markets were not expecting, I guess in many ways, the worst case scenarios taking place in terms of when the tariffs, what the tariffs will be. And on top of that, the additional 10% on China, right? So on your screens, as you can see, risk assets are selling off. Volumes are very heavy. And we're also looking at Bitcoin, in case you missed that headline which came through, now down. We're now talking about 82,000 on Bitcoin, also risk asset, 25% down from the peak. Market breadth, yeah, it's pretty bad out there. We will unpack the market story for you next, plus a lot more coming up here, of course, on The China Show. Let me try this. Happy Friday.
Question mark.
Welcome back. If you're a Bitcoin bull, look away now. Oh, it's too late. 82,000, 2.5% to the downside. it was big news when we took out 100, we took out 90,000, of course. So just to quantify, so we're down about 2,000 today. 25%, I think, is the drawdown, and that headline that some of our Bloomberg clients might have already seen, that pivot back, of course, from that high that we hit, well, a couple of weeks back. Okay.
Yeah, that's right. And actually, I have to say, it's not a particularly happy story if we look at wider China markets, Asian markets so far today. Anyway, shifting gears, think a little bit about property. We, of course, had the budget, Hong Kong budget coming out earlier, news about this, stamp duty potentially being a boon to some Hong Kong developers. And thinking about New World now. So we are seeing New World warning of a net loss for the first half when it reports today. That will be after market close. It's already written down the value of properties in response to a broad real estate slump in Hong Kong. We're joined by APAC real estate senior analyst from Bloomberg Intelligence, Patrick Wong. Patrick, just lay out what are the key items that we are looking for from New World, and how much detail do we need over this step to sort of add a lot of collateral against key assets to avoid a restructuring?
Yeah, the challenge right now, of course, for New World, they will report the loss there, right, already. And then I think what they need to give us more details, of course, they are going to have the leverage ratio, which everyone concerned about whether it's keep rising, which is very likely because they write down kind of like the investment properties or also the development properties have the challenge that the value also falling a bit in Hong Kong especially. And then the challenge right now for New World is upcoming, as what you mentioned, about the refinancing, right? Whether they need to patch lots of assets. If they did, right, for the refinancing, then next question is, well, they already have a target, right, in terms of long-core asset disposal, which they can't meet the target then, because once you patch the assets, there is more difficult for them to sell. Yeah.
Their peer in the industry, well, the biggest one, I believe, still. Is Sun Hung Kai still the biggest one in Hong Kong?
Yeah, Sun Hung Kai is the biggest one.
Okay.
The largest
one,
residential
right?
sales. And, yeah.
They did well.
They did really well.
Well, so how did they do that?
I think they managed the balance sheet really good in terms of sense that the leverage ratio only keep falling a little bit, less than 20% now, versus New World is 90% something. So yeah, that is the major difference when the interest rate going up over the past 2 years. So, and then for Sun Hung Kai, I think they also did a very good job in terms of manage the pipeline. So the pipeline keep increasing a little bit, so they can sell at pretty good prices at this point. So at the end of the day, I think they still managed a very good shape. Yeah.
Okay, and the outlook in 10 seconds, good or bad for Sun Hung Kai?
Well, Sun Hung Kai is still pretty good. They meet the target for the sales already, so they will keep I think they keep doing really well in terms of the sales over the next couple of months.
Thank you. Yeah. Patrick Wong there, of course, you put out a piece on the outlook there for Sun Hung Kai on your terminals for you. Right. Speaking of Hong Kong, let's stay here on the story here. So Hong Kong's sole delegate to China's National People's Congress Standing Committee says she is readying proposals to be presented next week at that key political gathering. Starry Lee also told us how the city government is navigating increasing tensions between Beijing and Washington.
Government do respond separately for each of the important act by different government and organization. I would say that we have to maintain Hong Kong as an important, gateway to different cities in the world, and we have to maintain our international contact to different parts of the world in order to, attract more talent, enterprises, and technology to come.
Given the fact that there are these external shocks potentially from a protracted trade war, and that the slowing Chinese economy is going to be a priority in Beijing next week, when you're there, what do you think is a reasonable deliverable for you as a representative of Hong Kong to get from the two meetings next week?
I think we have the duty to raise different suggestions to the central government.
Expanding the multiple entry visas beyond Shenzhen?
Yeah, this is one of the suggestions that we will make, because this policy will help to, further facilitate the movement of people and talent. And if you compare, there are a lot of visa-free arrangement for foreign people to come to our country. But, as when you compare to Hong Kong's situation, they even need to apply. Therefore, there are room for that visa arrangement to extend to different cities in Greater Bay Area and also to Shanghai and Beijing. Of course, it can also help to benefit our travel sectors and also the retail sector as well.
Do you feel that Beijing is getting a little bit impatient, though, with the pace of integration? You mentioned the Greater Bay, the greater integration between China and the Greater Bay and the greater mainland economy as well. Xiao Baolong was here recently. He talked about how he was very concerned about the pace of integration on the grand scheme of things. What's your response to that?
I think nowadays, things are changing. We are all facing different challenges. We need a quickened procedures, and we need some, mechanism breakthrough in order to further quicken the development of infrastructure, etc. Especially in Hotao area, I think. Greater Bay Area, of course, is one big area, but I think Hotao is another important concern raised by Xiao Baolong, right? Because we are, the modernization of our country need to have high technology development, and Hotao are being positioned as one of them. And now, up to now, still they are lacking infrastructure, lacking the railway. I think this is something that we need to pay more and more attention.
That's Hong Kong Legislative Council member Starry Lee there, speaking with Bloomberg's chief North Asia correspondent Stephen Engel. And just a quick eyeball of Country Garden now. We are seeing the shares jump as much as 30% in trading, now up nearly 12% there. And it's really a resumption of trading after this 9-month gap. We had some comments and developments on Country Garden's debt restructuring that have obviously emerged over those past 9 months or so. Yeah. Most recently saying essentially that it expects to reach an agreement with creditors on its debt plan by the end of February. So today, I guess.
Yeah, I think they're looking ahead. This is, I think, 18% yesterday, 12% now. The chair, in case of yours missed that, I think, what's today, 28th, on the 25th, late in the day, so still this week, so still quite fresh. The chair actually talked about how Country Garden will resume home construction soon following the new year and targeting normal operations come 2026. All right, that's what we understand so far on the stock price. Plenty more ahead. This is Bloomberg. Welcome back. More on our special drone coverage this week. You have Coretronic Intelligent Robotics, really one of the leading drone producers in Taiwan, and its tech and manufacturing capabilities are now, in fact, attracting international interest. So our tech reporter, Belle, of course, was with them and spoke to them about their outlook and also demand and also their growth prospects.
We hope that we can provide ODM service for the worldwide. That is our mission. And we don't plan to have overseas to set up our brand names, self-sales, networking, because this is what we really good at, manufacturing, quality control, and the new technology introduced.
So you see more US companies looking to Taiwan to manufacture drones?
Yeah, I think this is a way because Taiwan still got a very good background, and we got all necessary fundamental technology and skill, no matter it's a manufacturing or supply chain, and also, of course, the technology. So I think China maybe not right now for the government use is maybe not in their list. So I think Taiwan should be the best choice for them at this moment.
How concerned are you about tariffs, though, and the risks that those are put on to products that are made here?
I foresee that probably this will be the topic, but so far, because we still got a price benefit for the drone in the market, so I think we will, if the range is not so significant, I think we still can live for it. Yeah.
What level of tariff, then, could you withstand?
I would assume like a 10% around, but it's not easy to guess what the U.S. government right now, what is our target for it.
So after 10%, though, if that's applied, do you still think that Taiwanese drones are competitive?
That would be a kind of challenge, I may say. Yeah, more than 10%, that would be a challenge. But I think right now we will have a different. We will not only use the price to get the customers. I think we also using the new technology. So I think that both way that we can make sure, not because the customer buy our drone, not because only it is cheaper, but also it is as good as a US the drone.
So we know the Trump administration has a big effort to onshore or reshore certain critical industries. Do you have any plans to establish a presence there, whether that's through your own new site or by forming some sort of joint venture?
Because right now the quantity demand from US is good, but still not to support for the factory in US. So we will see if a timing is right. We also will consider this option.
So what's the quantity? How much demand do you need to be able to justify?
It's going to based on the profit we have. So I think maybe some kind of a veto or something. Some others high value product come out. It's more possible make this happen.
If you got orders for a VTOL product, so vertical takeoff and landing type product, that would be something that would make you move?
That could be the one of reason, yeah. So again, we'll see that what is the revenue we can get if we move to the US. I think this is something that we will think about.
That was Coretronic Intelligent Robotics Corporation's Andy Shin speaking with Annabelle for us in Taiwan. And as part of that special coverage of Taiwan's drone development, we'll also be hearing exclusively from the Vice Premier Cheng Li-chun. She discusses investments in critical areas and technological cooperation with the US.
Yep. Plenty more ahead, of course, on that interview coming up. Just a very brief look at the here and now. And the biggest decliners, as you can see here, are unsurprisingly, of course, some of the big winners of late. Down about 3.5%, call it even, 4.4%. So in terms of just fundamental news coming through, you have the Xiaomi story of Tencent, of course, coming through. Isn't moving the needle as much, although you could make the opposite argument with Tencent not down as much as some of their peers. It's also worth pointing out that they haven't also risen as much as their peers as well. As far as sector groups are concerned, every single sector is down across the Asia-Pacific, all 11 sector groups on MSCI Asia-Pacific. You don't have Taiwan trading today, so that might be adding to the angst we're seeing across some of the other tech-heavy benchmarks like Japan and South Korea. Hang Seng's down about 1.5%. So, yeah, it looks like investors are closing the books early on this week amid the tariff news and all the event risk out there.
Yeah, and we will be joined by UBS Global Wealth Management to break down some of that and talk about their market strategies. So stay with us.
Good morning and happy Friday. So far, the mood, generally speaking, among at least I'm in a good mood. Markets, though, as you can see, are not. 2%. It is, of course, a day to the weekend. So I guess why not look at the glass being half full, right? And the weather's actually quite nice out there, here in Hong Kong at least. 2% to the downside, though, and we are really just seeing an extension of the risk-off session that we had overnight. NVIDIA, of course, that drop post earnings, dragging down just about every single benchmark out there that had it. Plus, of course, you have U.S. data coming through as well, and then you have PCE coming through later today. This is as far as the Fed goes. So there's a lot of event risk out there, suffice to say. So the drop that we're getting here in Hong Kong, and flip the boards when you look at the damage across Asia Pacific, is really enough to drag the overall regional benchmark to the first weekly loss in 7 weeks or so. It doesn't help in this case today that NVIDIA was a really big part of the pain point and that Taiwan is shut, the Asia Pacific. So all that sort of concentration of pain focus has really been diverted to places like Japan and South Korea, which you see on your screens are down over 2% each on those benchmarks itself. In fact, 3% down is, yeah, there we go. That's the Nikkei 225. Seeing a pullback there. The dollar is the opposite side, right? So the dollar is actually on track now for the first weekly gain in 4 weeks or so. The good thing, though, as we look at the chip stocks, you see that shortly on your screens, is that U.S. futures are actually doing better which I guess in many, many ways shows it that some buyers might be showing up as you approach the U.S. Open today. But suffice to say, the next few hours will still be really a lot more like this, unless we get a catalyst, of course, coming through the next few hours or so.
Yeah, exactly. And this sort of recalibration, of course, we have seen the tech optimism driving so much momentum in this market and really offsetting some of these tariff risks. We have had this steady escalation of Trump measures before we got the additional 10%.
That's right.
CFIUS, shipping, more chip curbs. But maybe this is what really kind of snaps investors out of that mode of thinking, actually, we're going to see something quite moderate and modest. And this is going to be a much more aggressive phase. BE had a very nice note comparing the equivalent of 20 percentage points tariffs during the first 2 months, essentially, of Trump's presidency, compared to the whole first term, where it was 12 percentage points on China. So.
Yeah, the dosage now is cumulatively higher than what we had so far. And maybe to your point, that's what breaks the camel's back for now, right? Let's get a sense really of how we look at this from an economic perspective for markets which have done well in this side of the world. The U.S. markets have been struggling, of course, for traction. Joining us here on set is Ifan Hu, Regional Chief Investment Officer and Head of APAC Macroeconomics at UBS Global Wealth Management. Happy Friday. It's nice to see you. Let's get started with tariffs. They don't seem to be a problem until they are, like today. Where do you think the story goes from here? So do we have enough information to determine right now where the landing point will be on final tariffs?
In our view, we think because for the next week, the U.S. the tariffs on the Mexico and Canada will start 25%. So I think that's probably the reason for additional 10% announced today. So I think with the 10%
on China.
Yeah, on China.
Okay.
Yeah.
Okay.
So 10% plus 10%. So that's kind of the 20%, and also that's also could be a potential possibility. There is some additional. Add up, maybe after USTR's investigation, on April 1st. So as a whole, and our expectation is a base scenario, we think the effective tariffs this year will be up to 30% from the 10% last year to the 30%, because effective tariffs means you have the tariff 10%, 20%, but you have some exemption for some of the goods, and maybe you have the asymmetric tariffs. So in our view, the tariffs going forward could be more asymmetric. So they could put higher tariffs maybe on the capital goods, intermediate goods, but the less on maybe the consumer sensitive goods. So we think that as a whole, so they will try to balance the tariffs or try to increase the tariff revenues as an ultimate goal for Trump.
Okay, so your thinking is essentially the 20% cumulative China tariffs are really about staying in keeping with the tariffs that we're seeing imposed on allies like Canada, Mexico. In terms of what do you make of the global tariff impact? Trump imposing tariffs elsewhere. What is the impact to China?
Okay, so from this perspective, and we think the Trump has not only gave the pressure on China, but also the rest of the world. So we say, for example, the Mexico and the Canada, Mexico's 8% of the exports to the U.S. actually is re-exporting from China, rerouting export from China. But that's only counts 0.6% of China's total exports, so it's a limited impact. So, and also we expect some of the steel and aluminum tariffs going forward, but that's mainly impact on the maybe Canada and the EU also have limited in China. But another reason is because China also already have the 25% of the tariffs on the steel and aluminum, and also how the Trump proposed the reciprocal tariffs, especially for emerging countries and the EU countries on agriculture goods and also some of the commodities. But for China, it's not the issue because we already have reciprocal higher tariffs with actually the quite high already. So I think as a whole, the rest of the tariffs I think have limited impact on China. So the China, of course, we will still expect the effective tariffs up to 30%. But now if we look at in a global pool, I think the China is not at least it's not worsening off because for other countries also suffering now.
We have seen the likes of HS HSBC sort of warning also about this quote-unquote cascade of tariffs. So tariffs on China that now come from other Asian countries, that come from other big export markets for China. So, for example, Vietnam, South Korea have both said they're going to impose tariffs on certain commodities. How big a risk and how much does that cost the Chinese economy if we do see this potential for wide-scale tariffs coming from other countries?
Yeah, that's a good question. But based on the data, actually we see the size is not that big. Just as mentioned, Mexico's 8% of the exports to the U.S. actually is rerouting export from China. But it only counts China 0.6%. So for Vietnam, our estimation is also about 1 to 3%, because for many of the exporters, the manufacturer already set up their factory in Vietnam. So that's not count as a rerouting. But if the Trump just levy all the tariffs on all the countries, I think in our view, the most suffering one probably is the U.S. side, because it will actually give the huge pressure on its inflation.
Right. Now, let's assume you're correct. Let's assume that, because it's very hard to understand too, tariff here, tariff there, and what the net effect will be. And that uncertainty alone will keep investors away from deploying capital, right? Let's assume that the eventual economic impact on China from whatever the tariff settings will be globally will be limited. Do you think that limits the stimulus then, or the influence that go into policymakers that announce their economic targets next week? In other words, is there a connection between the uncertainty outside and what they plan to announce next week?
Okay, so for the tariffs on China, for example, 20% is our base scenario. So we think that will actually give the drag on China's GDP growth minus 0.7 to 1% for the 2 to 3 years. So of course, there's still some a negative pressure. So given that, we think that for the MPC, probably will come out a bit stronger stimulus package, because our forecast is a mild stimulus package, but the package could increase along with the U.S. tariffs. So currently, we still expect relatively mild and maybe some additional the add-ups. So currently, besides the monetary policy, I guess it's kind of the cutting the interest rate and the Qatar. So we think the most important actually is still the fiscal side. So this year we expect the 2 to 4 trillion additional central government, special central government bond issuance, maybe to be announced at the MPC. So mainly I use for the bank recapitalization and for the consumer goods a trading program, and also could be supporting some of maybe the housing inventory digestion, and also could supporting some of the social welfare network. So it depends on the size.
Do you think that this additional 10% plus the sort of latest salvo of all these incremental measures we've seen this week from the Trump administration, does this change the narrative more fundamentally for investors when they think about the impact of tariffs on China?
I think because I should say the China actually expect, I think the 20% actually, I think it's a 20%, I think it's a market consensus, 20 to 40%. So, but I think the market-based scenario mainly is 20%. So I think that's actually it's already factoring for the estimation. So currently, I think one of the good good indicator is for the USD CNY for the exchange rate. And we see for the first round of 10%, actually we see for the CNY actually appreciated a bit. And now also keep relatively stable. So that's mean the market already partially factor in the potential tariffs, and I don't think there will be dramatic the pressure. But we still expect a small depreciation for the CNY this year.
How does that affect this Chinese equity market rally? What's the investment advice now?
Okay, so currently for the China market, we still put the neutral view. The reason is because the rally is too fast. So yeah, we still think there's some trading opportunities, But for the tech sectors, we are still I think it's still quite attractive because it's a valuation is still relatively low. It's currently is around 15 times, comparing US is 25 times, and still it's on the it's still I think for the allocation is still not very high, and also driven by the DeepSeek and other for the software applications. So I think it's still given lots of boost for the China's growth as well.
Okay, excellent, Yifan. Excellent to have you break down and have the sort of instant reaction to all the news that's come this morning. That was Yifan Hu, Regional Chief Investment Officer and Head of APAC Macroeconomics at UBS Global Wealth Management. And still ahead, we have our exclusive interview with Taiwan's Vice Premier on why she sees cooperation with the US on tech, R&D and investment as critical to both sides. That conversation is coming up next. You're watching The China Show. Good morning. You're watching The China Show, and time now for Trending in China. And we are looking at fresh commentary on Taiwan in Chinese state media. So, China Daily is out with an editorial slamming Taiwan's ruling party, the DPP, for allegedly trying to get the Trump administration to support its, quote, secessionist cause. The paper is referring to the Taiwanese government's plan to boost cooperation with the US in critical technologies. It warns the island against relying on the US for protection, citing President Trump's recent comments on Taiwan and Ukraine's example. It says Ukraine has paid a steep price for its US backing.
Meanwhile, you have state media outlets here also reporting on the Chinese Defense Ministry's latest stern warning to Taiwan's ruling party. The spokesperson was, effectively reacting to the island's planned military exercises this summer.
They have seriously miscalculated the situation, the public opinion, and the difference in strength, which is reckless and extremely dangerous. We warn the DPP authorities that holding the tide with a broom will only end up in self-destruction. Sooner or later, we will come and get you.
Wow. Strong words there. It certainly comes as, certainly in the backdrop, is you have President Trump weakening, at least Trump's weakening of support for Ukraine. It's also casting doubt, really, on this long-held policy of strategic ambiguity toward Taiwan. Our tech reporter, Belle, is, in fact, in Taipei for us. Just give us more color here. And just the color in the context of the coverage you've done, Belle, so far as well. How do all the pieces fit in together?
Yeah, well, it's certainly been these comments from President Trump that are being very closely tracked here in Taiwan, and as you were saying there, what exactly it signals for strategic ambiguity. This is a US policy that's been in place for decades now, and essentially it says that the US won't say whether it would or would not step in to support or defend Taiwan in the event of any sort of invasion from China. Drones are really at the center of this. Taiwan is very much focused on building up its military inventory. The purpose of drones is to maybe allow them to carry out a policy of asymmetric warfare. So this is what we've seen in Ukraine, how drones have been used there very effectively by the Ukrainians to essentially allow them to compete with a much larger, a much better resourced army in Russia. Whether Taiwan still has that sense of the US being able to step in and be that strategic partner is the real question. It's something that we spoke to the Vice Premier about earlier yesterday. This was an exclusive interview with Vice Premier Chung.
The US has always been Taiwan's most important partner in terms of regional security and in trade. We are attentive to the policies of the new US administration, and different local agencies have been studying new areas for cooperation between us. The more important thing is identifying a strategic direction for the US and Taiwan and maintaining a mutually beneficial working relationship, so we can build a democratic supply chain that strengthens the US's leadership in the global high-tech industry, while also helping Taiwan maintain its competitiveness in making contributions to high-tech development.
And what is your assessment of the way that President Trump has changed his position very radically from the Biden administration on Ukraine?
Taiwan has been monitoring the development of the war in Ukraine and related updates from Europe. We want to do our part for the Indo-Pacific region. Enhancing military capabilities is the basis for peace. We want the Taiwanese people to recognize this. Therefore, we are not only committed to building up our defense capabilities, we are also strengthening our economic resilience. This way, we can continue to take on important roles and increase our contributions to the world. The President had set the 4 pillars for peace. They represent objectives like enhancing Taiwan's defense capability, enhancing economic safety and resilience, continuing cooperation with like-minded countries, and lastly, supporting orderly exchanges between Taiwan and China.
How does Taiwan prepare, though, for other eventualities? Because there's the tariff risk that is still very present, not yet fully clarified, but there's the chance that we see 25% tariffs on Taiwan semiconductors. How is the island preparing for that?
我们都密切地在关注美国新政府相关的 We are tracking new policies from the Trump administration closely. We want to show that the future of the Taiwan-US cooperation is focused on cutting-edge technology. This is mutually beneficial and it should be a shared goal. And we're willing to expand our investments in the US with the aim to amplify our innovations in technology, including AI, chips and drones, and even R&D in future technologies. We want to stay leaders in the high-tech industry amongst democratic countries. This strategy is critical for both of us. We will also make efforts to balance trade and our increased investments in the US.
Do you think that the US is still a reliable security partner to Taiwan?
我们认为台美是 We are important partners on regional security, trade and economic collaboration. We hope to deepen ties with the US, and we believe it will be done on the basis of the Taiwan Relations Act and 6 assurances. Since Trump became president, he's emphasized the importance of keeping the cross-strait peaceful and doesn't want to see a unilateral change of status quo by force, and most democratic countries share this same view.
So Vice Premier Chung has a very key role to play on the island. Not only is she the head of a task force that's focused on strengthening US-Taiwan ties, she's also overseeing the entire drone effort. And again, going back to that, Taiwan is very much focused on building up its self-sufficiency in this area, but it does face a lot of challenges in that task, and that has also been really the basis of our reporting this week. And you had that interview earlier with the Quartronic CEO or managing director there, talking about really the challenges that they face, not just with the ecosystem that's still quite fresh and underdeveloped in Taiwan, but also that continued effort to find new customers in places further abroad.
Well, fantastic reporting there. Thank you for joining us. That's Bloomberg tech reporter Annabelle Jewellers in Taipei for us this week. There's plenty more ahead. You're watching The China Show. This is Bloomberg.
Right, welcome back. Damage reports. This is a look at the sector movers across the Asia-Pacific benchmark. So MSCI Asia-Pacific is, and Rebecca will tell me the statistic in just a moment, the worst day in some time here. Everything is down from energy, which is the least scathed, all the way down through to industrials. But yeah, it's a bad day to be long these markets, Rebecca.
Yeah, worst day since February 3rd. So nearly a month now. Yeah.
Yeah, there we go. And it's I think it's worth pointing out that it's the last day of the month. It generally has been a good month for equities this part of the world, not just in mainland China, of course, not just in Hong Kong, rather. It's, the representation on the benchmark itself, flip the boards, please, has really been enough to lift the benchmark itself up almost clearly every single week up until this week. The downside, though, is coming in the form of still tech and the NVIDIA story and the AI story outside of the Chinese mainland with the drop in NVIDIA. And of course, you don't have Taiwan trading today. So that's really getting taken out across some of the Japanese listed semiconductor, including the South Korean names there on your screens. SK Hynix down about 5%. Right. Now, apart from this, though, and the damage is looking like, so we talked about MSCI Asia Pacific. Nikkei going into the lunch break is off by, and it's a bad day when we go with the points drop, 1,000 points on the Nikkei 225. Good thing, I think, encouraging, though, is you are getting S&P futures a bit steady going into, I guess, the rest of the Friday session.
Yeah, and to your point, you mentioned this earlier, but we have seen when it comes to Hong Kong in particular, really the trading being very different from the start of the day to the second half of the day.
Yes.
We had these quite big swings in sentiment, actually, and trading direction.
Yeah, which I guess bodes well when you look at how bad things are right now and how things could improve after the lunch break. But it's really one where there was a risk. I wouldn't say markets were ignoring up until this point, but
Right.
we're sanguine about when it comes to the tariff story. But now that we have something to talk about.
Yeah. I mean, this additional extra 10%, and of course, we're getting closer to facing the reality of a 25% for Mexico and Canada. It does seem to be changing. But of course, we've had such an effective offset when it comes to tech optimism and the DeepSeek rally. But really, perhaps now we are seeing a recalibration. We are seeing facing up to the reality that indeed, actually, tariffs are coming, and they are perhaps more intense than we were hoping for at the beginning of the year.
Textbook move, risk-off move across these markets on the back of that news Rebecca just laid out there. So the dollar is stronger against everything else except the Japanese currency, which, as you see on your screens, is dollar-yen is actually down in near session lows on this. It's a bad day when a central bank comes out with an adjective next to a verb talking about how they're intervening. I'm talking about Bank Indonesia, and what they're saying is, and my producer, there we go, intervene boldly in these markets. There we go. Plenty more ahead here on The China Show. Right, welcome back. We're headed into the Japanese lunch break, really on, I can't remember the last time we had a 1,000-point drop on the Nikkei. That's what we're getting today. And you see it when you see a black tile within the red square on this graphic. It tells you that this is a statistical aberration as far as the actual Z-score, the price move, is concerned. And you can really apply that quite fittingly right now to what's taking place in Japan. This might have to do with the fact that you are getting a good portion of the tech representation on the Nikkei seeing some massive downside. And on top of that, there's also the strength in the Japanese currency, which perhaps is adding to another sort of adding more downward pressure there on the connection between that and the currency and the equity markets. 149.35 right now on dollar-yen. Let's get more context and color on the market action today. Mark Cranfield out of our MLive team is joining us. Mark, what's happening?
People can't wait to get to the pub for the Friday afternoon. They just want to dump everything and get out of here. I think it's going to be it's going to be a very long day. I mean, we're only halfway through the Asian day. We haven't even seen Europe and the United States take part in this yet. It could be a long, ugly day for assets today. I mean, the way that obviously, quite rightly, people are focused on the fact that it looks as though tariffs will be coming next week. Maybe even earlier, because it's the weekend. Who knows? I mean, they might even decide to go quicker than expected. There might be something else. Weekends are always a treacherous time when you're in this kind of a situation where it's very fluid, where policies appear to be being made up one day to the next. Traders will be very nervous about the weekend. They'll be anxiously watching their news reports. Bloomberg will have a very busy news weekend. The people who are on duty this weekend will be very busy trying to go through everything and making sure people are up to date. So by the time we come in on Monday, it could be a very negative situation if we get even more reports So that's what people are preparing for. They don't want to carry any risk that they don't need to going into the weekend. And it won't be too long before we may even see a slight change of tone from the Federal Reserve. The speakers have been quite hawkish recently, but they maybe have to dial back on that.
Mark, yeah, to that point, we were joined earlier by a guest from Kaifeng. Really, his conviction call is that markets are underpricing a rate cut that could be forthcoming in 2026. Yeah, just lay out, what do you think the Fed response could be to all of this?
Well, if you look at the way Fed speakers have been going this year, they seem to be coming from the angle that their biggest concern would be inflation, that the new policies coming from the White House would give upside risks to inflation as the year progressed. Traders bought into that. They dialed back a lot on expectations for where the Fed would cut way into the latter part of the year. That's beginning to change now because the narrative is shifting a bit where investors are concerned that some of these policies actually will hit US growth. There could be an increase in unemployment because of what's happening with government workers. The sentiment, consumer sentiment, is being hit as well because of the risk of tariffs coming. So actually, US growth may underperform. Inflation won't be so much of a concern if everyone's dialing back on spending. And the Fed narrative may need to change. We're already seeing that pricing in the derivatives market is bringing forward the potential for interest rate cuts in the Fed to the middle of the year. Well, that may even come even further forward. The way, if you look at the bid for bond markets today, the markets that are open, Australia, Japan, Treasury futures, market is really going for bonds as a haven play here. That will increase the betting for people to price for an early interest rate cut from the Fed. Now, of course, the Fed has to endorse it. You have to see a change in the language coming out of Fed speakers. We haven't seen that yet. But this is a very, very fluid situation. And it means that the Fed meeting coming up in March, people will be watching the language very carefully. It probably won't be as hawkish as it was in January. It may even open the door to the possibility that it's much more of a 50-50 outlook in terms of whether they need to cut early or not.
OK, Mark. Well, yeah, looks like we'll all be glued to our Bloomberg apps and our phones this weekend. Bloomberg M Life strategist Mark Cranfield there. And China is struggling with stagnant consumer spending, weak inflation and a debt-ridden property market. All of that is raising concerns that the economy is heading for a repeat of Japan's so-called lost decades. The Bloomberg Originals team has been taking a closer look at how it might still be able to avoid that fate.
These days in China, people are looking for cheap eats. That's because a lot of people are feeling kind of broke. Discount delicacies like these have gone viral, especially at affordable spots like this Japanese restaurant, Caesarea. But meal deals aren't all China's picked up from Japan. The whole economy is looking disconcertingly similar.
A lot of people in China today are concerned about whether they are repeating what happened to Japan 30-some years ago.
That'd be stagnant growth, a burst real estate bubble, falling bond yields, a sluggish credit market, and an aging population. Not to mention price growth, close to zero.
China has reported its longest deflationary streak this century.
And it's pushing ordinary Chinese to be frugal at a moment when policymakers desperately need them to spend.
If consumers continue to opt to save instead of spend, then companies are going to make less money, they're going to have less to give to their workers, and that spiral will continue.
Unless that is, Beijing can learn from Japan's devastating lost decades before it's too late.
This is Tokyo, the world's largest, most rapidly growing city.
Japan's economy grew exponentially after World War II, and it peaked during the 1980s.
Credit was cheap, the yen was strong, and the economy boomed. Confident consumers borrowed to snap up property and stocks whose values were surging, while Japanese corporations splurged at home as well as on some striking purchases abroad. But the moment the 80s were over, so were many fortunes.
On the first day of 1990s, Japanese market began collapsing.
With every day, the Japanese yen sinks to new lows. There's exasperation on the Tokyo Currency Exchange.
After that, the lost decades began. We saw the property bubble burst, a debt crisis occurred, and people rushed to the safety of government debt.
Japan entered what's called a balance sheet recession. This is the first problem we need to understand. So imagine, you want to buy a house as an investment. You take out a loan to pay for it, hoping the property's value will rise. But all of a sudden, prices start dropping. Your household income remains the same, but you feel poorer by the day. That makes you spend less, pay down your debt, and secure what you can for the future. But saving's a good thing, right? Well, not necessarily.
If someone is saving money, someone else has to borrow this money to keep the economy going, right? If everybody's saving money, if no one was borrowing money, the economy will shrink like crazy.
Central banks have tools to control this, in theory. They can encourage borrowing and spending by lowering interest rates, as Japan did for a very, very long time. But if people and businesses fear that the economy has further to fall, locking their money away may feel like the smarter move.
You have to have borrowers out there for your monetary policy to work. If there are no borrowers, monetary policy doesn't work. It's dead in the water.
Which leads us to the second problem.
The financial institutions who are the recipients of this money have to put this money somewhere, have to place this money to earn interest. But if the private sector as a group is not borrowing money, the only borrower left is the government.
So investors start buying up government debt in the form of bonds. And remember Japan's plunging interest rates? The same thing happens with bond yields, as more and more investors pile in.
And that's why government bond yields come down to these ridiculously low levels.
Ultra-low bond yields have negatively impacted bank earnings. It has distorted the returns of pension savers. It also crushes investment returns for those looking to invest for income.
And that's what we're now seeing play out in some sectors in China. China's bond yields have been trending like this, down and down, reaching a record low at the start of this year.
In July of 2024, new loans in China were actually negative. So that meant people paid back more loans than they took out during that month. That was the first time that happened in 19 years.
And just as is the case in 90s Japan, it can be traced to an endemic real estate crisis.
For a long time, property was seen as the safe asset. At its height, about 75% of all household wealth was stored in property. And so as the price of homes has come down, that has really hurt consumer confidence because they're looking at the value of their home going down and feeling poorer by the day.
That's being exacerbated by China's demographic challenges. Its population is getting smaller and greyer. Again, just like Japan. It's a reminder of the very human, psychological components at play here.
就现在看来，我觉得可能不会有前2年这么好的一个时期了，就是可能会越来越往下的去下滑。
This is Molly Xiao, a 25-year-old professional based in Shanghai. She uses popular apps like Dianping and Meituan to find restaurants offering discounts. It's become a way of life for millions of people like her.
之前呢，在商场的话，会选择楼上，一般那种高档餐厅都会在楼上嘛，就是4到5楼。但是现在会更多的去选择 B1的那种，就是快餐类的。一些为了获取客流的方式嘛，他们会做一些优惠券或者是套餐，我们会经常去。其实。
While China's present economic malaise echoes Japan's at the turn of the millennium, some fundamental differences offer optimism that recovery is possible. Take a look at lending, for example. In 2024, industry loans were up more than 12%. Infrastructure was up as well. and real estate development was still positive. Taken together, this all shows a trend. At large, China's private sector is still borrowing. Economists also highlight China's greater room for urbanization compared to 90s Japan, as well as the larger domestic market it has to sell into. And then there's China's inventiveness.
Alibaba, Tencent are two of the world's leading tech platforms, and China has more software developers than the US by a ratio of approximately 3 to 1.
While there's no guaranteeing that China will have a technological revolution, if you look at some of the things that have happened more recently, I think that suggests that there's a possibility that China could see technological advances that could really change the trajectory of the economy in the near future.
Finally, there's also hope that the country can learn from its neighbors' lost decades.
China doesn't have to go through that. We lost a generation in Japan because we didn't know what the disease was.
The Chinese policymakers and the Chinese government now have a playbook to read on what exactly happened to Japan.
When you are in this type of recession, where individually everyone is doing the right things, but collectively you get the wrong result, government has to be in there to keep the economy going.
All right, we're just about done with the trading month, and about caveat, of course, with the full month left as far as the quarter is concerned. So before today's pullback, actually, and this still could be the case by the time we wrap the quarter up, Hang Seng Tech is actually on track still to be to better the NASDAQ by the most if you take the quarterly spread in at least 10 years. So it's really been a turnaround of sorts. Now, does it continue is the other thing altogether. Now, a lot of the buying has really been fueled by just this mountain of cash that's come across the Stock Connect. So to tally things up, net flows southbound for the month, not including the still positive flows we're seeing today, $18 billion. Second biggest amount on record. That's net. And yeah, so we're feeling bullish here still.
Yeah, and we were just chatting about this, but two sort of big narratives now coming up against each other. Of course, we're having the worst day in several Asian equity benchmarks since essentially the first round of tariffs were announced by President Donald Trump at the beginning of February, seeing a bit of a repeat in that market today. But of course, that has been massively offset, particularly when it comes to Hong Kong, by this real sort of wave of southbound buying. So, I mean, yeah, interesting to see how that sort of resolves itself.
Yeah, there's DeepSeek, there's Alibaba, there's Baidu, and then now we have, guess what? Tencent has actually joined the fray. But yes, and of course, there's a Xiaomi story to tell you about too, and this new model.
So, yeah, on this theme about Chinese tech, two, by the way, Xiaomi and Tencent, two really popular names when it comes to southbound buying. Xiaomi has just released its latest high-end EV model, the SU7 Ultra. Weibo users are praising the car's design and price of under 530,000 yuan. So that's about $72,000, saying it's good value for money. And by the way, that is actually a reduction of how much it originally cost when it was announced. So that was upward of 100,000 US. So if you pre-ordered, you're now in for this amazing surprise. You've saved about 30,000.
That's a good arbitrage, isn't it? It's kind of like similar when you buy an apartment and, when the building hasn't been done yet, right? But anyway, I digress. To Rebecca's point here, just to build on that, so users are also reacting, in fact, to the CEO, Lei Jun's Weibo post, saying that after 2 hours of sales, get this, and we now have a figure on the pre-orders, they've now exceeded 10,000, reaching a key target. Thank you all, and good night. Some users replied saying, can Lei fall asleep while owing so many cars to customers? Mr. Lei, please get up and build cars. Don't go to sleep.
Yeah, I mean, everyone wants to get their hands on this, right? Yeah, pretty extraordinary to see this. I mean, basically sort of an ultra luxury sedan coming to market, kind of dressed up as a sports car at this pretty phenomenal value. I mean, but also speaks to this real competition in China, of course. Anyway, we're also looking at another part of China's high-tech sector, with Tencent launching its own new AI product that it says outperforms DeepSeek. We're joined by Bloomberg Intelligence senior analyst Robert Lee here. Just kick off. What does this mean for Tencent?
Okay, I think starting on a positive, the big tech platforms, not just in China but globally, stand to benefit from utilising AI within their businesses to drive efficiency and cost savings. So Tencent, as I think I've said previously, is playing the long game in AI. They're not in a rush. They avoid the hype and hyperbole. So they're still a leading tech platform in this part of the world. They've got very deep technological and balance sheet resources. They've come out with their latest model, which, again, they're claiming beats DeepSeek on some measures. But as we know and as we've seen in recent weeks, I wouldn't be surprised if another company comes out next week and claims something different. So I think Tencent stands to benefit by applying this within its own business to drive savings. Is that going to have a transformative effect on their earnings outlook? Probably not, but at least there is some potential benefit for them. And then the more important question, as I might have mentioned once or twice previously for the industry, is how are the rest of the companies going to monetize their developments? Because humongous amounts are being spent on CapEx. Consumers are not really putting their hands in the pocket at the moment. And, you know, we still remain at a very early stage in terms of the commercialization of this technology.
Yeah, I mean, it's funny how markets behave, don't they? You know, the lack of visibility on the monetization on Chinese tech has driven a lot of money in. The opposite side of that is NVIDIA, which has told us they will make $40 billion in sales as far as the guidance goes. So that's clear. That's almost money in the bag, but yet markets reacted and sold the stock of 8%. So what do you think was behind this indigestion of that information?
Well, again, as we said before, the NVIDIA story is extremely well known. It was priced to perfection previously, very high expectations, high valuation. But I guess the narrative on NVIDIA, you know, is shifting, it's changing, and people are beginning to focus more on the risks that the company faces. Again, the numbers speak for themselves. The company's still doing extremely well and will continue to do in the short term. But what are the risks to that outlook? Because the rate of incremental upside or incremental outperformance, not just stock price, but in terms of earning outperformance, doesn't seem to be coming through. Maybe that's partly the base effect. You know, we've had beat and raise for so many consecutive quarters. As the base grows larger, it just becomes so much harder to do that. But the narrative, I think, is changing on some of these big tech names because whilst they remain an effective monopoly in terms of what they're doing, there are risks. There are risks in terms of competition, you know, such as Broadcom and Marvell trying to catch up. Some of their customers are now designing their own chips. As I said, the bullish outlook is extremely well known. We had a story break in the States, I think, about a week ago from a broker claiming that Microsoft was beginning to pull back on some of its AI data center rentals. So again, you know, the bull case was priced in. The narrative is shifting, you know, I think, across the sector.
OK, 30 seconds or less. Are we in an AI bubble?
Look at NVIDIA's stock price. You know, that peaked roughly in the summer of last year. It struggled to maintain the highs since. So I think I'm not questioning the narrative, but again, there was a lot of hope, a lot of hype priced in. It's all about show me the money. It's all about monetization. I think that's where people should be focused for this year.
Robert Lee, fantastic. Thank you so much. Out of Bloomberg Intelligence there. Right, so before we wrap up the show, we'll get you guys a look really at some of the big movers across these markets. So plenty more ahead. This is the China Show.
It's going to be a very busy week ahead for us, Dave. Okay, you better get all your rest this weekend for Monday. Look at the items on our calendar. We're kicking off with the Mistral IPO. We've already seen spillover in terms of the optimism for bubble tea makers and suppliers already. Tariffs, this big question. The March 4 date set by President Donald Trump, very significant. The day before President Xi's NPC, National People's Congress, which of course takes me on to the NPC. What are we going to get in terms of fiscal stimulus? stimulus. And finally, earnings, JD.com also coming through.
Yeah, and really how they're looking to, I think that's the e-commerce space, and how they're looking to frame their guidance on the back really of developments in tech as well, right? And what's interesting, going back a step here to March 5th, because the work report is, I believe, 9 a.m. that day out of Beijing, with the Chinese premier coming out. About an hour after that, across the Pacific, you had the U.S. president, I believe, I'm looking at my schedule correctly, he's set to address both chambers of Congress. So how those two things literally collide on air will be interesting, and how markets digest all that information. In the meantime, though, despite that, so the narrative remains constant and consistent. Despite the pullback we're getting in price, mainland buyers are again buying this dip, as you can see, with positive net southbound flows.
Pretty extraordinary. Nothing can stop them.
Yeah, there we go. And just to wrap the show, there we go. That was a Starship reference there from Rebecca. Happy weekend. We'll see you all on Monday. This is The China Show.